Hey guys, Brian here. Hope your week is going great. In this video, I just want to share a few insights from a free report we just released. You can download a copy using the links below, but I want to talk about Treasuries today. This is supposed to be a safe haven asset, but long bonds are now down more than 50% since March 2020. This sell-off is changing the investment picture in some important ways, and we'll talk about how it's changed and what we are looking at now. Stay with me. All right, guys, welcome back. And let's just go ahead and put up this chart first and foremost. This is just a spread between volatility on a long Treasury ETF and volatility on an S&P ETF. So what it shows is that relative to stocks, volatility in Treasuries, highest in 21 years. Again, this is supposed to be the world's safest asset, and Treasuries are, at the moment, way more volatile than equities. In addition to volatility, there is this chart showing the issuance of Treasuries. Blue line here is marketable debt pushed to 14 trillion. The gray bars are the 6-month change in outstanding net debt. That is pushing toward 2 trillion. So what we have is essentially soaring supply at the same time we have soaring volatility and falling demand. And these trends are steering investors away from the Treasury market. That at least is the mainstream explanation, supply and demand. Feel free to take it or leave it. We approach things differently. We look at markets in terms of waves of social mood, and that's why we've been showing this chart. It is the 5-wave decline in long bond futures. It's a classic impulse wave. Prices have moved ahead of the mainstream narrative that revolves around supply and demand. Our view is that once this wave is complete, that's going to mark a larger degree bottom, and then we'll see the largest counter-trend price rally, so a fall in yields, the largest since the March 2020 peak. So that's where we stand in terms of Elliott Waves. You might think that this would be good news for the economy if interest rates come down. It's easier to service the outstanding debt. We actually think it's going to be quite the opposite, and we get into that a little bit in this free report. So don't forget to download, use the links below, and thanks for watching.